This is a podcast from the Business Times.
New retail sales report, Justin, up 1% in July, better than expected.
This is more than double what we were expecting. Wow, despite the concerns about rising prices, this is a strong number, and I can't take away from that.
Consumer prices in the U.S. rose at the slowest pace in more than 3 years in July, bolstering the case for the central bank to start cutting interest rates. And even with the looming general election, the focus is still more on where the economy goes and what the Fed does. In due course, the elections and who's leading the races will obviously become a bigger factor, but right now everyone's talking about whether there'll be a soft or a hard landing for the U.S. economy. Welcome to Money Hacks, a podcast series by the Business Times, where we explore useful financial tips and help you on your money managing and wealth growing journey. I'm your host, Howie Lim. And helping us today, Charu Chanana, Head of FX Strategy and Global Market Strategist at Saxo.
And we've seen a little bit of that spike around pricing in elections when we had Trump being shot and then, Biden stepping down and Kamala Harris coming in the picture. But since then, I think it's quietened down a little bit. We haven't heard very radical policies coming out in terms of campaigning they're doing right now. That is likely going to pick up as they campaign a lot more. And that's when markets will start reacting. But the first focus for the markets, at least into the September Fed meeting, is really about how big the rate cuts can we get.
Isn't everyone concerned a recession is around the corner, though, even though the U.S. economy seems to be leveling out at this point in August?
Actually, I would say, the U.S. economy is really like a two-lane economy. There are parts that are really reeling under the pressure from those high interest rates. And they would like to see those installments on their home loans and stuff like that come down. That's certainly something that can boost the economy a little bit. There are other sections of the economy, I totally agree with you, where they don't seem to be getting as much an impact from those high interest rates. Probably they've locked in fixed interest rates at the time when, interest rates were super low, or they are probably not as debt dependent as well. So those sections of the economy, the wealthier Americans obviously seem to be still doing better. And that's what is really visible on the surface in the headline figures of growth and, stability. But under the surface, there is some amount of nervousness. The Fed is obviously very, very focused on achieving a soft landing, but they don't want the economy to come to a hard stop. And to be able to achieve that, they probably need to step in and cut rates at a time when the situation hasn't worsened dramatically.
Charu, some analysts feel that the interest rates in the U.S. are about 1 or 2 percentage points too high, and that the unemployment rate is an ominous sign as well. What are your thoughts?
The timing is obviously something that is difficult to put an exact estimate on, but there is a certain degree of restrictiveness in the US economy. Like I mentioned, this two-lane economy, the weakness, the parts of the economy that have been weakening, that is broadening out as well. So you will in due time see the impact of that coming onto the headline numbers as well. If I was to take an estimate or a guess on the timing of the first Fed rate cut, I would obviously be very attentive to what the Fed has been saying itself. And we have actually heard from Chairman Powell himself that they are moving towards a rate cut. Now, whether we get that in September or November, which is the meeting is, I think, 3 or 4 days just after the US election, that becomes a really political move in the eyes of some of the investors. And if you want to kind of move before the situation worsens dramatically, before you see, maybe a smaller bank reeling under the pressure of those high interest rates, I think September looks like will be the most opportune time for the Fed to really make that move.
Or would you say you're leaning towards the outcome of being a soft landing, and that's dependent on how many percentage points they adjust the interest rate? Talk us through the potential outcomes then.
Right now, we are of the view that the probability of a recession or the probability of a US economy coming to a hard stop, which means, a quick rise in unemployment and a fast pullback in consumer spending, that probability remains quite low. things are still holding up okay. About a 30% chance that the US economy will actually get into a recession. So obviously a greater probability that this soft landing or a slowdown in the US economy at a measured pace that can be really achieved. But there are structural risks to further upside in inflation. Again, we're getting into a US election, and as an aftermath of that, you could see probably an uptick again in tariff wars, right? In trade tariffs, which is inflationary. This rapid AI development that is prompting a lot of focus on energy and infrastructure around that. And green transformation is something that is also back on the minds of politicians after being put back on the sidelines for the last few years, I would say. So that green transformation, if that picks up from here, is also inflationary in nature. Plus, we haven't had supply chains post-pandemic being restored to what they were in the past. So there are these concerns around inflation. And to top it all, US fiscal spending, that continues to raise concerns about inflation going higher again, or probably at least not coming back to that 2% target that the Fed has. Now, if the Fed sees that as the bigger risk, right, and they cut rates at a very measured pace, they delay the rate cuts, there is obviously going to be growth risks escalating for the US economy. So we really need to see whether the Fed is able to make that move towards rate cuts and how those rate cuts really feed back into any reflation risks or risks of growth accelerating also in the US economy. Actually, the post-pandemic economy is very different from what we've seen in the past. So there's really a tricky game right now because they don't have past precedents to really rest their case on.
Still to come, what is the best possible outcome for everyone with regard to the US economy landing soft or hard? More with Charu Chanana from Saxo in a moment.
Money Hacks now comes to you every Monday. Get useful financial tips every week. How much to save? What to invest in? Howie Lim asks the experts, so you have the answers. Money Hacks by the Business Times. Every Monday, go to bt.sg/moneyhacks or wherever you get your podcasts.
And now, back to Money Hacks from the Business Times.
This demonstrates the economy might not be slowing as much, and the labor market actually might not be diminishing as much as the jobs report demonstrated.
We've discussed the state of the US economy so far. Chanu, what do you reckon? What's the best case scenario, and for whom would that be the best possible outcome?
I think soft landing is really the best possible outcome from an economic perspective for the American consumer. It is really the best possible outcome for everyone because recession can obviously be extremely problematic for a large section of the society, not just the poorer parts of the economy, but really, the retailers and a large section of the economy would be impacted negatively if we were to see a recession. If you're looking at it in terms of the markets, of course, there are different parts of the markets that react positively to a soft landing scenario versus those parts of the economy that react more positively to a recession scenario. Say bonds, right? Bonds would probably not do as well in the case of a soft landing. Some defensive sectors of the equities as well could probably do better if you were to see a hard landing. From an overall headline level, the market's so much priced in for a soft landing that it can have huge negative impacts if that assumption was to be questioned and if we were to get closer to a recession.
At this point, Charu, where would you say the US economy is headed?
There are a lot of scenarios, but if I was to plot growth and inflation on two axes and kind of make a 2x2 grid, there's actually 4 scenarios here, very broadly speaking. When your growth and inflation is lower, you certainly know that you're entering a recessionary period. But there can also be a scenario where inflation is high and growth is low, which is called a stagflation, right? Which is an even worse scenario, I would say, in terms of the consumer as well as the markets, because that's where you are reeling under the pressure of higher prices and obviously growth is bad as well. So I think that scenario is something which is also, I would say, a lower probability, but a higher impact kind of a scenario, because inflation risk, for me, I don't think we should be putting inflation risks on the back burner for now. And then there's a fourth scenario of reflation or no landing as well, where growth is high and inflation is high as well, which is usually a good scenario because growth is high, but inflation being so high is obviously going to mean more cost of living pressures after having dealt with that for such a long period of time. Because there are no past precedents to really rely on in the post-pandemic era where things are shaping out to be quite different, it's rather hard, but I'm pretty clear that even though inflation may not go back down to 2%, we've seen the peak of inflation. We are moderating from there and we might settle down around the 3% mark. And the consumer and the US economy will be flexible enough to deal with that kind of an inflation. Now, what that kind of inflation also means is the policy rate from the Fed will potentially not go down back to those 0% kind of levels that we've seen in the past. It will also have to settle in at a higher rate because inflation is structurally higher. So again, that can mean growth continues to be lower than what we've seen in the past as well, which is obviously going to be the big question. But really, to answer all these questions, we need to see what kind of a policy does the Fed adapt.
Okay. But what about retail investors? I mean, do they wait to see how this all plays out? What should they do?
As an investor, as a long-term investor, you should stay calm and not react to such panic situations, especially not react to one single data point. I always assert the fact that one data point is not a trend. So the July data has been hinting at US economy weakening a little bit more, but until I get August data, I will not be confident to say, oh yes, US economy is really getting into a recession. Just stay calm. So some investors try to rush and close out their positions when they see such reactions in the market. And later, when you kind of close out your position, market goes down further, you think, oh, wow, you've done a wonderful job of closing your positions in time. But you will probably still not be able to time your re-entry into the markets very well, right? In a situation like that. So I think the best strategy would be to just ride out those volatilities. But the best way to do it is to have a well-diversified portfolio, right? Have some exposure to defensive sectors. Consumer staples, healthcare, and utilities. Those are sectors that outperform some of the other sectors of the US economy in case of recessions, because consumers are still going to pay for their utilities, their groceries. So those are sectors that still do better than the others. Of course, have a diversified portfolio across asset classes as well. So bonds have been yielding so much in the recent years. So certainly a good time to lock in that income. And if you do potentially move towards a recession, you would also get a good amount of capital appreciation on those bonds. Probably have some exposure to commodities in light of that expectation around inflation settling higher. And of course, when we talk diversification, also have some exposure outside the US market. So a regionally diversified portfolio.
Okay, we're always told don't time the market. It's about time in the market. But timing is still important. I mean, how do we take timing into account when it comes to rebalancing our portfolios then?
Yeah, so certainly that's a very good point. Rebalancing is very important, especially in these kinds of markets, right, where you've seen US equities continuing to rise by such a big amount in the last few months. But I wouldn't time my rebalancing to what's happening in the market. I would time my rebalancing in a stipulated time gap, like maybe every 6 months. And then I see, oh, yes, I want my equity exposure to be 60%, but because of the gains in US equities, it has gone to 80%. So yes, I need to kind of cut down somewhere. Or I would time my rebalancing according to how my risk profile is changing, right? If I'm approaching my retirement, then that's when I need to have a very different portfolio to what I had a few years back when I was still having a job. Maybe if I just totally lost my job, then I need to be cautious about my risk and return profile changing. And then that's when I would reposition my portfolio, rebalance my portfolio. But reacting to market moves of one day can be quite tricky for long-term investors. If you are a long-term investor, if you have time on your side, I don't see why that is not the right strategy. If you're young, if you have a good exposure to US equities, again, I wouldn't worry about whether the S&P 500 is at a record high or is it going down the dips. A more active investor, your return expectation would be really to outperform the markets. And in that case, I would obviously be on the lookout for where are some specific stocks or specific sectors where there are opportunities to really outperform the index as a whole, where you potentially think that the US economy is slowing down. Then, I would probably look at, maybe even shorting some particular companies, some particular sectors as well to be able to, again, outperform. I would certainly adopt the approach of dollar cost averaging, continue to invest a fixed amount at regular intervals. And so if the stock price is going down, then eventually you have an average price which tends to be lower and you get the desired exposure as well. Stay away from just responding to extreme market moves if I have a longer term time horizon.
Charu Chanana, Head of FX Strategy and Global Market Strategist at Saxo. Next time, how does employee financial well-being improve business outcomes? We get insights from the folks at Endowus, Aon, and Intellect. This has been Money Hacks from the Business Times. I'm Howie Lim. Till next time.
This is a podcast by the Business Times. Find more BT podcasts at businesstimes.com.sg/podcasts or wherever you get your podcasts. This podcast is meant to provide general information only. SPH Media accepts no liability for loss arising from any reliance on the podcast or use of third parties' products and services. Please consult professional advisors for independent advice.